So, what is today about? Well, a lot has changed. We're seeing quite a lot of change within revenue, and we're seeing the change in the way they're approaching R&D claims. But more broadly, we're also seeing quite a difference in the way the government's talking about funding and trying to build the economy back out of the COVID year that we've had. So, what we're going to talk about this today is, as we said in the invite, we're seeing a lot of change in HMRC. So firstly, we're definitely seeing them scaling up their inquiry team. So I go to the consultative committee and they are talking about nearly doubling their team. So we're seeing a willingness to now go and inquire into claims, and we're seeing a willingness to take claimants to court. So today's session is going to focus really on two of the tribunals, but they have won 3 tribunals over the last year. And also, we've actually now started to see a few convictions coming through for fraud. So Revenue really are starting to flex their muscles in terms of the R&D scheme. So we're going to run through 3 key areas that have been tested in court, give you the background, explain what's going on. But I expect you'll have some questions as we go through. So if you think of anything, there is a chat button on the presentation. If you can type it in there, and we'll pick it up at the end of the Q&A session and discuss what your thoughts are, and if you've got any questions about what we're talking about. So if we go to the first slide now, and I will hand over to Luke, who also works in the R&D team with me, and he'll just give a brief introduction to the R&D scheme in case of people who are not so familiar with it, and then we'll move into the technical details.
So I was just saying that I'm going to go through some general high-level background to the R&D tax credit scheme and what it actually means for your business. And then we'll go into the main details of what this presentation will cover. So I mean, firstly, it is important to emphasize that if you are investing in developing innovative products or processes, R&D tax credits are a great way to generate cash. Typically, a successful claim will pay out within 28 days of the claim being submitted. This can be put straight back into your business and reinvested in R&D. And as well as this, the scheme is actually structured in a way that you can factor the benefit into the budgeting phase and planning projects if you're confident the work you're planning to undertake will qualify. And this is something you should speak with an advisor about when planning your R&D strategy. So what benefit will the scheme actually generate for you? So the scheme for SME businesses is very generous, with loss-making businesses able to claim back 33% of the qualifying spend as cash. This can actually be a really significant amount, and it's something businesses should always be factoring into their planning, because it actually allows a business to invest in riskier innovation and trialing new technology while maintaining a tight control on costs. And this type of investment has been shown to help increase a company turnover, and it can even increase the chances of becoming a listed enterprise. So, as I highlighted a minute ago, despite the COVID restrictions, HMRC is still working to their 28-day turnaround. And this is good news for businesses. It means this type of vital innovation support will be quickly accessible through challenging times. And I mean, in fact, the R&D tax credit scheme is probably one of the most efficient ways of generating innovation funding. So the scheme is proven to work and clearly does provide a significant source of benefit. However, it is very important to not cut corners when preparing a claim. And this is for a number of reasons. So errors in a claim can actually result in a delay in benefit, which may mean significant administration costs. However, HMRC can also start an inquiry into your R&D tax credit claim, even after it's been fully processed with money paid into your bank account. And businesses have actually been asked to pay back significant amounts, which can really be challenging. It can even cause issues with future funding rounds or acquisitions when investors carry out due diligence into a business. So how can a claim go wrong? We've seen a number of tribunals coming out of HMRC, and I'm now going to pass back to Ian, who will discuss some of the key challenges.
Thank you, Luke. So the 2 tribunals that I think we'll look at on this one are the THK and Heyde Engineering. But how do they get to this point in the first place? Well, the companies will have been given an inquiry, given time to respond to revenue. There will have been, in most of these cases, about 4 or 5 rounds of correspondence, and then it's gone to courts to sort out who's right in terms of the claim. And I think really what we're seeing with these, as you can see here, 2 different sectors. One's IT. THK was very much around IT. Heyde Engineering's a proper engineering firm, manufacturing and making fabrications. But both of those were challenged in terms of are the projects eligible? They went into the documentation, HMRC went to the documentation and said, don't think this is qualifying. On THK, they also took a challenge at the competent professional and saying, does this person actually have the qualifications to be making the assessment? Do they understand the underlying technology well enough to say that it's an advance? So we're also then looking at the HADE one, and that is a substantial tribunal report. It's a good half an hour's worth of readings to get through it, but record keeping comes out again and again as a problem. And who should be claiming the development? Whose R&D is it at the end of the day to be claimed? And we've seen this really in issues around subcontracted R&D. So that's where we're going to go now, is to look at those individual aspects of it. So to start with, I'll run through the issues that we've seen with record keeping. So can we move on to the next slide? So record keeping sounds like it's going to be relatively straightforward, but Revenue focused very heavily on this on the HADE tribunal. So this is a metal fabricator. It's producing bespoke pieces of equipment such as cranes, heavy lifting gear that you can't buy off the shelf, and they had to go away and come up with a solution, or that's the way it was described. But the Revenue weren't comfortable really with what they were seeing. The biggest problem was that most of the costs that were being claimed seemed to have been put into cost of sales rather than on a project basis. And Revenue are then worried, if you can't link the cost to the eligible project, how can they be comfortable that this is a qualifying project? So when we're talking to clients, we try to make sure that early on they start thinking about this. So can you put in place record keeping that maybe tracks the project? You might not have to go all the way to proper project accounting, but at least putting numbers on the record so that you know where they fit with the projects. Unfortunately, HADE did some of this, and it slightly undermined their case when Revenue were looking at the numbering and realized that there were discrepancies in it, which is why it really does need discipline, and it needs a standardized approach. And as it was in this one, it needs an approach that can be passed on. If somebody does leave the business, you're not left stranded trying to work out what their system was. But I think the bigger issue with the HADE tribunal was the lack of clarity about what was purchased. And we see this time and again, that invoices come in from suppliers and they say nothing, service provided, or per quote such and such. And this is where you end up with a difficulty of knowing, is it a material, is it a subcontract, or is it a provision of service? And that split is important because you have to treat the costs in different ways. And if you were a large company, the subcontracted costs might have to be excluded. So Revenue looked at the invoices and actually went down to the level of trying to get the records and started to find discrepancies. So this is what we do as a team. We actually go in and look at invoices, we look at contracts to try and make sure that there is that linkage between what's being claimed and what's actually on the invoice. And if there is a discrepancy, if it isn't clear, we then disclose that to Revenue. And this is where items like the report can be used to try and explain why certain costs have been put into certain cost categories and why Revenue might see something slightly different with the invoicing. But I'll discuss about the actual contracts later on. But I think the key thing that comes out of the HADE tribunal in particular is, if you're putting a claim in, you need to have your record keeping sorted out. And it really needs to be on, if possible, a real-time basis so that you're picking these things up. Coming back retrospectively and finding things are not quite what you wanted, it adds to the time and complexity of preparing your claim. But sometimes things don't work out and you have to try and explain to Revenue how you've apportioned things and how you've gone through actually pulling the costs out. So that's where we're going to move on to next, because when you haven't got that information, you need to put it into the report. So I'll get Luke to run through the key areas that HMRC picked up in terms of the report and the challenges they had around that area.
Yep, thanks, Ian. Yeah, so as Ian said, particularly if you're record keeping isn't comprehensive, the documentation submitted to HMRC becomes really important. And this is for a number of reasons. Firstly, it's used evidence that as a business you understand the R&D tax credit rules. But as Ian highlighted, mainly it allows you to supplement your accounting data and demonstrate why the expenditure is claimable. So it is really important to show how your business meets the R&D criteria, and there are a number of things your documentation needs to demonstrate. So you should be explaining how the eligibility assessments have been made, what expenditure has been incurred, and how this fits within the categories of qualifying spend. And if you do this properly and set out the information clearly, this will make a really big difference when your claim is being reviewed by the inspector. So the type of eligibility assessment needed for an R&D tax credit claim will depend on the particular details of your company and the type and volume of R&D activity being carried out. So firstly, the report should evidence that as a business you understand the R&D rules and how they apply to your business. And this can actually be a bit tricky, as the definition of R&D for tax purposes can differ from other definitions of R&D. And we saw this in the recent AHK tribunal, where HMRC's frustration with claims focusing on activity that doesn't sit within their definitions was clear. So, I mean, as examples, things like pure mathematics, economic research, and social science isn't considered eligible work. So it's always worth speaking with an advisor who understands the rules, and this way you can make sure you're capturing all and only the eligible work and are presenting this to HMRC correctly. So how do you actually go about making an eligibility assessment and demonstrating this in your documentation? So when a business is only undertaking a few R&D projects, we can assess each project individually, and the findings can be explained in the report. However, when a business is undertaking lots of projects and looking at each project individually isn't feasible, things do become a bit complicated. So in this instance, you'll need to apply a sampling approach, and the approach needs to be statistically sound and account for any outlier projects that may not fit within your sample. And how you select your sample will depend on a number of factors, such as the similarity across your projects and how much eligible time can be captured in certain projects. And having this type of efficient eligibility assessment in place that can be justified to HMRC will save time in preparing the claim, and it will also avoid the risk of an inquiry. So the report must also explain how the qualifying costs are identified with clear reference to the R&D legislation. So, I mean, usually when preparing an R&D claim, staff costs are typically the biggest costs. So if we start looking at the staff costs and what your documentation needs to set out. So, I mean, again, determining the relevant proportion of time that can be claimed and how you justify this to HMRC will depend upon how your staff time is managed. So if you operate a time writing system, we can calculate an hourly rate and apply this eligibility assessment apply this rate to the eligibility assessments. However, if you don't have systematic staff records, you have to come up with an estimated time apportionment for each staff member. And this time needs to be allocated on a just and reasonable basis and to reflect time spent on qualifying activity. And in this instance, it's really important to be linking back to the eligible project. And the documentation will need to demonstrate that you've understood their rules and how they apply to your expenditure. And this needs to be done across all categories of qualifying spend. So, I mean, many businesses in the manufacturing and engineering sectors also incur costs related to materials and software. And while we can potentially pick these costs up in the claim, there are strict rules which do trip claimants up. For instance, we can only claim software costs related to development as opposed to production, and the expenditure needs to be clearly apportioned based on any split. And consumable materials can only be claimed if their ownership has not been transferred during the course of ordinary business. However, often it's not really clear-cut understanding if your costs meet these criteria. For example, a business may transfer ownership of a product for test purposes, which may leave scope to claim. And while this can be tricky to navigate, it is really important to do this carefully with the advice of experts, as it's very likely the initial HMRC decision will be based on this report. Is it right if we jump across to the next slide? Yeah. So one of the most important parts of the documentation presented to HMRC is the technical description. And this explains the technical advances and the uncertainties in the eligible projects being claimed. So when we present an eligible project to HMRC, it needs to be clear that the company have sought advances that have in some way gone beyond existing technical capability within the sector. And for the claim to be successful, we need to show that the underlying technology behind any performance and functional improvements has gone beyond the technology that previously existed. And this is one of the most important parts of an R&D claim, but it's also an area where applicants are tripped up, which actually frequently results in claims being rejected. For instance, particular styles of expression and writing are known to trigger concern with HMRC. So if we look at the Haydée Tribunal again, the use of the word bespoke was repeatedly challenged. HMRC take the word bespoke to mean a tailored solution rather than a solution which is innovative and eligible for tax relief. And we also need to be avoiding terms such as functionality. So high-level descriptions of the overall commercial purpose can raise concern with HMRC, as they've made it very clear they're not interested in features and functions. And this distinction between a commercial advance and a technical advance is very important. A claim needs to articulate why the advance being sought constitutes an advance in the fields of science or technology, rather than just an advancement in the company's offering. However, again, the distinction is not always clear. For instance, you may be developing a new product which overall is an R&D, so it may entail things like market research and plugging into existing technology, activities that don't always qualify. However, we do find that when you dig into projects, there can be sub-projects that do qualify. For instance, there could be issues around integrating existing technology to achieve the new performance. So it's always worth speaking with an advisor for clarity on this. We can dig down into your projects and check you're only claiming eligible activity and not missing anything out. So the next section in your technical write-up is the uncertainties. And the uncertainty section need to explain why achieving the development improvements was not readily deducible to a competent professional. And the explanation needs to go beyond simply stating that the uncertainties exist. You need to explain why they presented a significant technical challenge. And again, if we look at the Haydée Tribunal, this caused further issues. So the ruling states that the design process should be systematic and planned. And as such, if your work includes ad hoc work or trial and error, this wouldn't constitute a systematic approach and therefore isn't eligible for R&D tax credits. So it needs to be clear for the inspector when they're reading your report that you've identified baseline technologies and then systematically sought an improvement. So finally, the project needs to be linking back to the eligible costs. So for this, you should be explaining things like testing phases, failures and iterations and what they entailed. And the inspector needs to understand why you required the provisions being claimed to carry out the development work. And this again presented issues for Haydée, as in their technical write-ups, it weren't clear at all why they were claiming costs related to steel, and there was no linkage back to the eligible work. So I mean, if you do this correctly and you're rigorous with your approach, ultimately you will save time and resources. And this is why, I think as Ian mentioned earlier, we always look at our claims through the eyes of an inspector. And this allows us to be confident they'll go through the approval process with minimal risk. So part of our claim preparation process is digging into the technical work to help you understand what has been developed and how this fits within the R&D legislation. And as every project is different, it's only through having these discussions that the advances and uncertainties can be properly articulated in the claim. And in part, that is why we urge caution against using automated R&D claim preparation tools. As things stand, they lack the sophistication to capture the nuances between development activity, which HMRC will be looking out for. So yeah, for this, it's always worth speaking to an advisor. You can understand how your project fits within the R&D legislation, and then it can be properly articulated, and you'll avoid the risk of an inquiry. Yep. So I think now I'm going to pass back to Ian, who's going to discuss some of the issues around subcontracted R&D.
Okay, thanks, Luke. So I think this sort of follows on from what Luke is saying there, that there are parts of the legislation that are not easy to understand, and subcontracted R&D is one of those. Quite often we'll say to clients, go and have a look at the CRD manual to get guidance that Revenue are providing. But on this aspect, even Revenue know their guidance is not very helpful because they're muddling up what subcontracted R&D is. But what we're talking about here is where the claimant company has subcontracted somebody else to do part of their R&D project. So if you're an SME, that's then claimable, but there might be a restriction applied to it if it's a third party. If you're a large company, you won't be able to claim this unless it's going to a university or effectively a non-corporation taxpayer. So it's quite important to understand what this type of payment is. However, there's also the other way around when the company is being subcontracted to undertake R&D. And this means somebody paying you money to undertake the work that you're performing. And Revenue find that this is the area where they get the biggest number of errors. And what we're looking at here is that for the SME scheme, any work that is funded by a third party can't be claimed under the small company scheme. It has to go under the large company scheme, and that's slightly less beneficial. And as I said, there's certain restrictions and you can't claim it. The problem is, what does subcontracted R&D actually mean? And the Haidee claim and tribunal have sort of tested some of the boundaries on this. And what Revenue did in the tribunal is actually go into the contract, go into the invoice, and look for what was paid for. And some of these ones said payment for X person working on development work on behalf of the client. And Revenue then turned around and said, well, you're being paid for that work. It shouldn't be under the SME scheme. And this is where there's an issue, because if you were then taking the risk on that project yourself, you would be able to claim it. So how do you make that differentiation? It's actually very difficult to do, and it's one of those areas that we have quite a lot of discussion with our clients about. But basically, what we're looking for is, if you're being paid for the work and that's part of the contract terms, and it says we will pay you that for the work you've undertaken, irrespective of what the result is, you're going to get the funding for it. That's funded. That's more like a grant. If, on the other hand, the contract says we will only pay you if you produce a product that gives this specification, then that's undertaken at the risk of the company. And Revenue are comfortable with those sort of splits, but they are starting to challenge in this area. And within the consultative committee, this came up again as an area that Revenue wants to really have a look at and make sure it is being applied consistently and sensibly, and people are not claiming for things they shouldn't be. But that then comes back sort of to our first topic we were talking about, which is clear records. So do you have records that show who bears the risk within a project? And is that something that could be shared with Revenue? I've seen many contracts that are set up on just a templated basis, and they are ambiguous at best, or maybe contradicts actually the way the work was undertaken. In which case, you can say to Revenue, actually, this is how the work was performed. It was more on the basis that we took the risk, therefore we're going to claim it. And Revenue will potentially go to your competent professional and challenge them to say, well, why was that the case? Can you give us evidence? So one thing you do need to think about all the way through the claim is your competent professional could be brought into these discussions. So are they comfortable with talking to Revenue? Are they comfortable with defending the claim? But subcontracted R&D is a tricky area, and it's one that Revenue say that they find errors, and this is why they are very concerned about it. So if your work is on behalf of a client or a customer and they are asking you to undertake R&D, it's definitely worth checking with an advisor and making sure you have got that split right and you don't have any risks there of Revenue potentially used in the Haidee case and trying to come and challenge you. So I realise that's quite a technical area and one that is somewhat nuanced and grey, and it needs some careful thinking about, and we have checklists and various other things we try and use to do that. But I hope this has been useful in terms of the discussion to show you the technicalities of what Revenue are trying to go after in terms of their inquiry process, where they're pushing at companies to make sure the claims are correct, and where companies are making errors and mistakes in the claims they're putting together.